defenses to it. Have them release or acknowledge that they have no causes of action against your creditor. Those are some things they can do that don't cost money. So if they truly want to cooperate, those are some things they can do in a workout. And as a creditor, you should be expected to do some things also in return. And then everybody will be happy. Let's get the release worded thoroughly as to the debtor, guarantors, and other insiders, where they're releasing. And similarly, if you are trying to get cross-referenced financial statements, so that not only do you know that your borrower is claiming that the equipment belongs to her and not to Uncle Pete, but you're also getting, with their permission, an acknowledgement from Uncle Pete that, yeah, that's right. So you can get some insiders involved at the workout stage too. Here is a trap for the unwary. And the bankruptcy trustee has a duty also, and they often use this, right? They will say, I know you got a blanket lien, but bankruptcy's federal law, and in its wisdom, Congress has stated that as to certain blanket liens, if you do not finance the acquisition of those items, excuse me, I said bankruptcy trustee counsel, I mean bankruptcy debtor counsel, bankruptcy debtor counsel. If you did not finance acquisition of those items, bank, we have an exemption in tools of the trade or something like that. Does South Dakota allow tools of the trade exemption to go into farm machinery to a limited extent? You have a specific exclusion for that. Tool of the trade would be then maybe some construction equipment, traditional tools, that sort of thing. What?
We don't have a separate tool of the trade exemption. We just have a personal property exemption.
Okay, so you have a personal property exemption, which could then be impaired.
Sure.
Okay, right, exactly. So this fits. I just need to use the right words. Thank you both. If this exemption is impaired in personal property, then it becomes significant whether it's a purchase money lien on that or not. If it's a purchase money lien on that, it'll be more difficult for, and if not impossible, for the bankrupt to use Section 522 of the Bankruptcy Code to avoid the lien to the extent it impairs the exemption. So how does this relate to workouts? And there's the case, or the statutory site, by the way. How this relates to workouts is you can get, when you're dealing with, let's say, a farmer over the years, individual farmers, so they have exemption claim, it's often kind of fuzzy. Did we finance that attachment, that corn head or bean head, or didn't we? Well, you didn't really write the check to John Deere for them to acquire it, but you kind of financed the trade-ins over the year. You provided an operating line of credit that they may have used to replenish the checking account that did write the check. So why not, during the workout stage, get in your workout agreement an express representation that all of my ag equipment or whatever, you do have a purchase money lien on. If that's colorably true, that's a chance for you to get that representation. And debtor counsel, you probably have not seen this attempted yet because it is a specialized technique in workouts. But now that word's getting around, be alert to that, because that then becomes a legitimate bargaining tool in your toolkit where you can say, no, I'm not going to sign that because I do think that a few of these items were acquired without purchase money lending by the bank, or at least know that what you're giving up there. Questions or comments on that? Lockbox arrangement can be agreed to. Sometimes that can be a win-win if you're collecting accounts receivable because once the accounts debtors, the people who owe money to your borrower, learn that a bank is collecting, sometimes it becomes an occasion for requesting a discount. Whereas if you're just collecting into a lockbox, they don't need to know that the bank is providing the muscle and resources to try to achieve that. And that could be a P.O. box that the bank legitimately controls because it was granted by the workout agreement. I want to talk briefly about language to reduce the risk of bankruptcy modifications. I have 2 or 3 case sites. If anybody wants them, just email me. There's still a split of authority in this area. In other words, can you agree pre-bankruptcy that this is our agreement, we intend it to be binding in a bankruptcy, we don't want it modified, etc., at least absent an unusual change in circumstances. And then recite off a bunch of things that you've already considered and that will not be considered a change in circumstances, such as a change in the marital relationships, such as a change in the tax code. We've already considered that. We think this is the best deal we can achieve. We don't want it monkeyed with in a subsequent bankruptcy case. Such as change in weather. Now, a bankruptcy judge, as we know, does not have to enforce that. It's not self-executing. But it will be a factor considered if the borrower in a subsequent bankruptcy tries to get even more concessions from a lender. And there are good reasons why a bankruptcy judge only considers it as a factor. But if you word your workout agreement properly, you can increase the clout that you get there. And think about the non-bankruptcy insiders, right? Even though you can't bind completely an entity once it goes into bankruptcy, what if the owner is not bankrupt? Okay, can you get them pre-petition to sign an agreement agreeing that they will not vote in favor of a bankruptcy plan that changes the deal, or that they will not advance money to fund a bankruptcy plan that changes the deal? There's some things you may be able to do with non-bankrupt insiders. Control agreements. Control agreements usually trump financial statement filings. So if there's some investment property, stock account, commodities account, something like that, try to get a control agreement over it. Some of these things are obvious. We've talked about specificity. This will help you value your collateral. If there comes a quick motion for relief from the automatic stay or to use cash collateral or something, you'll know, because you got it during the workout stage, how valuable that item is. Applying the accounts to the debt. This is sometimes referred to as set-offs. And this deserves special mention, really. A lot of times, a positive bank, a cooperative community bank, slips into the pattern of honoring overdrafts. So the workout agreement is an excellent time to deal with that, where there's been historical honoring of overdrafts, even to the point where a savvy debtor lawyer might say, we really kind of have a course of dealing here. We really have an agreement binding on the bank that it honors overdrafts, at least through harvest or whatever the pattern has been. You can try to clear that up in a workout, but if you can't, at a minimum, send a lawyered letter. Get the lawyer to word it, even though it probably should come under the bank's signature, saying we want to confirm that there's no we're sending this letter to confirm that we aren't promising to honor overdrafts. And that sort of puts them on notice not to count on this, because of course the damages factor can be high, right, if you start bouncing checks wrongly. You may decide that you have to sometimes allow overdrafting because of the nature of the payee on the check, but be careful, because you don't want to be a creditor in control of the operation, right? Not only will that potentially pose problems with the Internal Revenue Service through their specialized concepts of creditor control, and put liability on your bank, potentially, for the taxpayer's debts, the borrower's debts. But it also has a common law concept that might bite you if you become in control of it, much as the board of directors should be of a corporate borrower or so forth. So be careful when you tactically decide to honor some checks and not others. Get legal advice on that. Bank accounts, though, do provide you with significant opportunities for early detection. If you see a check to a well-known bankruptcy lawyer, that might be a sign you need to pay more attention to that borrower. If you see that they're shifting funds to another financial institution, same issue. You can see collateral proceeds going in, and if they're coming out without reducing the loan. Let's say you decide you want to do what's traditionally called a set-off. I like to call this instead applying the proceeds of the account to reduce the debt, and here's why. I don't want to box myself in, Leanne, to one remedy, and then if I botch the set-off, does that mean somehow that I can't argue, well, that was my collateral after all? You know, it was all the money in the account was really my collateral. So I like to be vague, and legitimately vague, and just say, I'm applying the account proceeds to the debt. We hereby give you notice of that. Then you've got both your statutory and common law set-off rights potentially, but you've also, if they were collateral proceeds, you've got your UCC rights on handling the proceeds. Now, be careful though, because either way it's going to have relationship effects. It's going to, I almost said 9 times out of 10, Caitlin, but maybe I should say 10 times out of 10, anger the borrower. And sometimes you just have to do that. I like to call it, Keith, I like to call it tough love, you know, but be aware that it will negatively affect the relationship. So I would call the debtor. Obviously you want to send them a letter, so you've got official notice, but I would call them and say, hey, we did this today, you know, just so they have that courtesy. Maybe they write a few less checks than they otherwise would. And then here, for you specialist lawyers, when I first saw this, I thought, this is completely nuts, but this is a nuclear bomb if it would happen to work for the debtor counsel. And I hesitate to say this since 90% of my clients are creditors, but I promised Matt that we would try to learn together, okay? So if in fact this is collateral proceeds, do they have to send a notice of disposition of the collateral proceeds before they apply it to the debt, much as you would if you were going to sell the collateral, right? You'd have to send that reasonable notice of disposition. I don't think so. And I haven't seen any legal authority that so states. But if it's a CD, maybe there's a policy argument there. Because maybe the borrower, if the bank had given the borrower notice, would have said, I would have had my wealthy wealthy lawyer, lend me the money, and I would have paid you off. You wouldn't have had to cash in this CD, charged with the consequence of early penalties or whatever it is, and so forth. So just be careful and get legal advice if you're setting off against CDs, because you may or may not have to give notice of disposition under the UCC. Can that be waived? Sometimes, and that's where your workout agreement can come in handy too. But a lot of times you can't waive that in advance of the default, right? A lot of times a pre-default waiver is not effective as to that. Okay? Well, we're in South Dakota, so I gotta tell a motorcycle story. Is that okay? Now for you who have been thinking, this is great, but I need a little bit of consumer relevant lecture, now's your chance to ask questions, make comments, because we're going to talk about kind of a consumer sort of problem, or at least a individual sort of problem. Let's say you have a person named Hurt who is riding a motorcycle, and you can tell he grew up in South Dakota because he's got that helmet on, by golly. Okay, just teasing. And gets in an accident in Sioux City. Solicitor, research lawyer, Dr. Young treats Hurt and does a good job and does a $9,000 unsecured credit. Dr. Young's staff has explained an intake to Hurt. Fees are due in 30 days after billing, no discussion of interest or finance charge. They eventually bill with an invoice. And a lot of times creditors will put stuff in the invoice that they didn't talk about ahead of time, okay? The invoice says, in this case, finance charges of 18% a year. Hurt doesn't pay, okay? Now, this Dr. Young would have been better, doesn't pay anything, doesn't pay the $9,000, any of it. Dr. Young would have been better off if, in addition to the invoice, she also had on her consent and intake form a reference to, hey, you're going to owe a delinquency charge here if it's not paid, or maybe a sign in the lobby, or both, and told them orally at intake, all three of those things. They're not all three needed, but Dr. Young would have been better off had she done that. Young hires Tom Collector as a legal counsel to work out the debt. The collector sends a demand letter to her demanding the $9,000 plus the finance charges from the date of billing. They include the debt validation paragraph, right, because it's probably a consumer debt that we're trying to collect. And the collector's alert enough to know they need that. All right. Now at this point, we synchronize watches, and it looks like I have about 6 minutes left. Is that right? That look right, everybody? Nebraskans can still keep time. All right. So, we're just going to issue spot for you a little bit here. I want to talk about truth in lending. Okay? Of course, it only applies to consumer credit and their exclusions and so forth, but I want you to notice in this hypothetical that Tom Collector is talking about finance charges. Young's invoice is talking about finance charges. Bad idea. You're better off under Truth in Lending Act circumstances talking about delinquency charges or maybe statutory interest or something if you have a statute for delinquent interest. As soon as you use that word financing charges, it begins to sound more like a credit card or a bank loan for a car or something like that. And then you have to give potentially all kinds of disclosures under the Truth in Lending Act. If you're making notes, I'll just give you a couple case sites or statutory sites. 1602F as in Frank. Talks about the extending consumer credit for which payment of the financing charge is or may be required. Okay. 1603 gives an exemption if the amount financed exceeds $25,000 or more and is unsecured, but here it was $9,000. There's some substance that may be required, which is disclosure of details of the total amounts of or methods of calculating the finance charge, total amount or method. If it's an open-end plan, which this may be, in other words, it wasn't a fixed agreement at the time you went in to see exactly how much your bill would be. It wasn't fixed at the beginning probably, so it may be considered open-end credit. Then you're supposed to give detailed information as to the finance charge amounts added during the billing cycle, the outstanding balance on the account, etc., etc. And typically, once a year, you're supposed to give a billing rights notice. Now, the typical medical provider doesn't do any of that. And it's not because they're wicked, it's just because they haven't come to these seminars. And now we, as legal counsel and as creditor representatives, consumer credit counseling organization people, now you can help the businesses of your state really comply better with this law. It's still okay to try to charge delinquency interest times or delinquency charges. Just don't call it finance charge, and do a better job of getting the wording right, which we'll come to in a second. Remember, they only had it on the invoice. They didn't have it in any oral agreement, any form that was signed and filled out, even a sign in the lobby. Now, what are some potential, so this is a potential defense and cause of action against it, Dr. Young. There's another one which would be oppression, trade practice violation, things like that. The logic here is that some states consider it a trade practice violation if you advertise things for one price, okay, and sell them at another price. So the thought would be, gee, Dr. Young, you advertised your rates as one thing, and now you're in effect charging me more because you're charging not only the $9,000 but the quote-unquote finance charge. Okay, and there's been no contractual agreement here unless more is shown. Now, many of you know much more about South Dakota 535 than I do, but notice that it only runs from the due date, not from the billing date. So this is not going to say Dr. Young if she is charging interest from the billing date. How about Tom Collector? Tom Collector has his own concerns also, because Tom Collector may be in trouble under the Fair Debt Collection Practices Act because it prohibits in 2A a false representation of the amount or character of the debt, and a false or deceptive under 10 means to collect or try to collect the debt. And even though this was an honest mistake by Tom Collector, it was overstating the situation to say you owe it from the date of billing. Okay. And depending on the sophistication of Dr. Young's office, keep an eye on whether there's a cause of action for failure to supervise Tom Collector activity. Okay. Now, I'm Hertz lawyer, okay, solicitor. What if I miss all this? Am I in trouble? Just a point to ponder, okay? And that's one reason we learn together in these seminars. What questions do you have? Questions, comments? Well, I appreciate your enthusiasm on a Friday, and your, I saw a number of people taking notes, and if you have any comments back to me, be sure and share them during the break as we all learn together. Keith Gower is going to help us do that, and Keith is with Davenport Evans, and very savvy and experienced in not only bankruptcy, but payment card programs, and and things like that. So is there a way that you could kind of up the balance here, you know? And is listed in best lawyers and chambers and partners as a good, excellent practitioner in these areas. He's going to talk about collections and foreclosures. And let's welcome Keith Keller.